All right, moving forward. So here's a little bit of a financial hack. If you do have interest and depreciation, it could be rolled back into your profits. Okay, so the loans that you're taking, or if you have equipment, you can depreciate that, even real estate over here, right? You see everything in green, interest, depreciation, the 42,000, the 103,000. You add that with the $33,000 in the net income, which is what they're paying taxes on, $179,000 in net income, from that. Pay taxes on your 20, 30%, however that's framed with your, I mean, I'm not a CPA or anything like that, but that's very little on close to $750,000 worth of revenue.
Yep.
And so these are little different small things that you can implement in your business on getting approved and having a low tax bill. Okay, so really, really work with your CPA, and again, your CPA, they're going to be wanting to deduct as much as possible, but again, they have to have a financial strategy. Be honest, right? They clearly are, but what we want, the faster it is for us to get there. If we think general, we get general. So,
Yep.
which one do you want to be? Right, guy on the left, person on the right.
Mm-hmm.
Right? Very similar net profit if it was by itself, but again, you're getting qualified for the return on the right when you get to that stage.
Mm-hmm.
All right, demonstrating free cash flow. So it's a general rule across all the loan programs and financial documents, right? Even your bank statements, tax returns, even no docs. Okay, and so there's a formula with it, what they look at. If you're going in no doc or you're going on projected things of nature, but you have a lot of business debt, that could also go against you if you're not, calculating it correctly. And this is
Mm-hmm.
the formula these banks use. It's called your debt service coverage ratio. So essentially, is your net operating income, right? Your interest, depreciation, there's other elements of cashbacks, and your total debt service. Essentially, for every $100,000 you want to borrow, you need to show around 125,000 in net income. So if you look at your gross revenue, right? If it was $1 million, 10% of that on average is $1 million, and 10% of that is 100,000. It's the potential loan amount that they'll approve you for.
Mm-hmm.
So with your interest, depreciation, some elements of cash back, and then your net income, right? That other example of that tax return I showed you with 179,000, that would qualify for here, not the one on the left. So your business debt versus your business income, in simple terms, is about 12.5% of your net income,
Mm-hmm.
right? Including your debts, right? Your monthly obligations with your debts, etc. So when you look at your current position, and then you say, hey, I'm going to go ahead and add that new 50, 100, 150,000, even for equipment, any type of loan. This is actually a formula that they use in all commercial lending. So your current debt services, and then if you add that new loan amount of 100,000 with a 8-9% BLOC, 5-year term, etc., what that monthly payment is, they're going to add all that together, and they're going to say, are you at a 1.25%? Or are you less? If you're like 1-to-1, that means you don't have enough free cash flow to do that, to qualify for that loan. And this
Mm-hmm.
is a prime example of one, banks want to know your business debt schedule. What are all the business debts that you have? So if you were one of the people that took out your SBA EIDL loan, is a 3.75 interest rate at 30-year note, which could be very, very inexpensive. It's like $600-700. Then
Wow.
you have a Wells Fargo, a line of credit, unsecured, $600. Your B of A, right, $2,000. You have an equipment loan for $1,000. But then you look at these MCAs, right? That $50,000 MCA is going to be costing you $10,000, $11,000 a month. So which one would you want to be able to get rid of first to get you in line?
So with Marco's situation, without getting too personal and throwing his business out there, everybody knows that of the MCA situation, of you taking him from 250,000 in MCAs all the way down to about 125,000 through your connections that you helped do.
Mm-hmm.
Tell the problem with what he had going on with MCAs, right? So that way it really lands with people. Because when a bank's looking at all those MCAs, right, he's really going off of his cash flow for his business. That's how he's establishing his credit. Remember, capital, cash flow, right, collateral, or credit partner. Those are going to be the four ways, guys. So he was going off of cash flow, right? Because the credit wasn't there. So the cash flow's there. He's basically becoming a slave to the MCAs, and he's got to pay those off, and he's paying high interest, and his profit margins are slipping. So the whole goal is to get him out of those horrible debt products that have been maintaining him, reduce that amount, so now we can actually go get him business lines of credit. Is that correct?
Yeah, yeah. So the first thing we have to do is go in there and see, number one, does Marco qualify by himself, right? Through the whole, I mean, how's the business? Does the business have any challenges or derogatories, late collection charge-offs, whatever? And so a little bit of the element is that we have to look at a credit partner,
Mhm.
looking at a different company. Like luckily he did have other companies.
Yep.
And so I
He
said,
just
okay,
said in the chat, guys. He said in the chat he was paying $1,500 a day. Imagine that being you. Right. Shout out some of my favorite Mexicanos in the building. Like, that is a lot. I can't imagine paying $1,500 a day. That is a
yes.
lot. Like, guys,
So
imagine he's got a family. He's running a restaurant in California. Okay. Communist California.
So, Mark, are you okay if I kind of talk about the strategy that I created for you? Okay, cool. When I looked at Marco's scenarios, that he did have a credit partner that had good credit, et cetera. I said, hey, do you have a credit partner at all? He said, yes. He had one or two people. Out of the two, we chose that one that he secured. I'm like, cool. We have somebody that can be, the face of the thing, right? Your company's a car, switching out you as a primary driver to the passenger, putting the credit partner in that section here. All right, number two, his current company had some derogatories. I think it was an old charge off or something or late. And I said, okay, well, no matter what, right now, your company as it is kind of toast. I can't do anything, even if we have a credit partner at that point.
Mhm.
Not saying you have to throw away the whole company, but that derogatory has to seasoned and let some time go by before that gets reestablished with a business credit, et cetera, because you have all these UCCs, 4 or 5 different MCAs, et cetera. But luckily, he did have a separate company. Again, the name of his restaurant doesn't have to be his LLC name.
Mm.
Okay. And so you can create, and he had 2 or 3 other companies. I said, let's use that company, create your DBA it matches. Let's take the merchant account, qualify for another merchant account for another company. So now the revenue is not flowing from LLC A, we're flowing it through LLC B.
Mm.
So the merchant account, all that money that's going through is going to be built up another one. Then you're going to take the revenue, enough revenue, so that we can then service the debt for LLC A. That makes sense so far. A little
Mhm.
more advanced.
Yep.
So credit partner, put them into LLC B, build that up, get 3 months of business bank statements on a
Mm.
clean, built up element, get some business credit, et cetera on that. So now we have 3 months of business bank statements. We have free cash flow flowing through. And that was my essential high level, the solution on how we can get him, right? If he's doing close to about 1 million, something like that in revenue, that's 100,000 per bank. Go to 4 or 5 different banks, so you probably get them $500,000. All right, guys. So personal tax returns, right? Very, very similar aspect as I was mentioned to you on the person on the left. Your adjusted gross income is what business owners of lenders look at for your fundability. So if as you can see, other income, typically from your Schedule C, if you make a whole write-off, carries over to your personal, that carries over down. So you can see he had a wage earner of 51,000, but then he had a major loss with his business. He lost $103,000. You're not going to get approved for a mortgage or any type of personal loans or at all, right? So person on the right, $98,000, from there. So what's good? Very, very self-explanatory. So Debt to income ratios essentially is your average amount of expenses, typically divided by your average amount of monthly income. You want to be around a 35 to 40%. So if you have $4,000 in your monthly expenses or $10,000 in your monthly income, divide those two. In mortgage, they're going to look at the last 24 months and have that average. If you need to, there's only two things you can do here, right? Decrease expenses or increase income. By doing that, you can then add a joint borrower, right? If you want to manipulate the way